Canadian real estate has allowed homeowners to make incredible profit by extracting the value of their home in the form of an HELOC, home equity line of credit. Coupled with extremely low interest rates and mortgage rates, you have a recipe for maximal debt expansion. Give people the ability to borrow money, and they most certainly will. This, of course, historically has never ended well, and this time will be no different. You came here for the truth, so let me unveil that for you. Today we are going to have our focus on the Canadian real estate crisis that is brewing. Let's begin. First, I want to look at the Bank of Canada's interest rates, okay? This is at the level of 1% right now. Over the previous months here, we've seen it slowly been ratcheting up, slower and slower, and it was a surprise the last time around. Nobody thought it would happen, but it seems to be moving in the direction upward. If they continue at the pace that they have done, it would take a few more years to get up to a level that would be normalization. That would be a very, very long period of time when you consider the fact that it would be 10 years since the crisis by the time they could get the levels up to anywhere near normal. 10-year time frame. That is anything but normal. And here we are having this bubble persist, and they will not do anything about it. They will not act at the speed that they should. Look at this. We're looking at the mortgage rates. As a result of the central bank interest rates, you'll see mortgage rates that are at very low levels right now. Variable mortgage rate, you can get it at 2.05%. That is historically unbelievably low. Then you look at a 5-year fixed mortgage rate, 2.83, also historically very, very low. So does it surprise anyone that they will give them as much money as they possibly can, buy whatever they want, and then get into the home equity line of credits? That's the way that this system has been supported. I'll get into that more in a moment. You're looking at the stock market, the TSX, okay? This is the major stock market here in Canada, and you will notice one very important fact, that it is approximately 16,000 here on this chart, but prior to the financial crisis, it was around that level as well. So if you were to factor in inflation, you would know that we would need to be much higher up here on this chart to have this be equivalent. So 10 years may pass before it gets to the same level it was before. That is shocking to me, but of course, people don't see it that way. They only see the short term. Now, some of the problems that Canada has had is related to oil because the prices had dropped significantly. Canadian exports of oil suffered as a result. They're not making the profit that they did, and of course, it's expensive oil to get out of the ground. The Canadian dollar has suffered over the years as well since the financial crisis. Looking at this. Falling home prices in Toronto in September dragged down the Teranet National Bank National Composite House Price Index as it posted its first monthly decline since January 2016. The national index, which includes 11 cities, fell 0.8% compared with the previous month. It is the largest monthly decline since September 2010. So there's some facts that are presented here that then will show you the contradicting information because it is very variable, as you will see. Let me get more into that in a moment here. All I want to say is that April was the peak where we had the highest housing prices, and it seems to have stagnated ever since then. But we're talking about from the highest point of this major bubble. So it doesn't surprise me that we would have a little bit of a correction anyway. This right here is one of these fund managers, and they're talking about this here. Can we discuss your holdings on the Canadian financial services sector? This is the biggest sector, overweight in TD Canadian equity. And it gets into basically owning all of these banks. And then it talks about Brookfield Asset Management, right? So this one big company, major institution here, they own a lot of real estate. And by owning the stock, they say that they own real assets. And that is not really accurate at all. Because look at their performance during the recession, previous recession, and you will see that just like other stocks, they declined. So it's not real assets that held that value throughout that time. This is the silliness of the fund managers. They don't realize the fact that they don't own real assets when you own paper assets. That's not That's not true. It is presented that way in the financial media, but it is very, very silly. Also, the fact that they are overweight in particular sectors. They are very overweight in Canada on the financial services industry, and you could see that with most people. If you go to the downtown core, what are the biggest buildings? Most cities anyway. You'll see that the financial services, because they're able to make money off of nothing. That's the way it works. Looking at this, for the first time since 2012, we are seeing real estate in all 5 of our largest cities appreciate at a manageable, healthy clip. Canadian housing is enjoying a Goldilocks moment. Not too hot and not too cold. That's right. That's what they're claiming here out of CBC, suggesting to everyone that it's great. It's great that it's not rising so fast and so high, and now it's just a little bit, and so that's very good. However, there was no correction seen, so it's not good yet. If it were to come down, if it were to correct significantly and then grow at a healthy clip after, absolutely, I would be all in favor of that. But it's not. It barely, infinitesimal levels came down and barely has climbed ever since. I don't know what's going to happen with the real estate market, but I know this. I'll show you this in a moment here. Looking at this, the prices right now, you can see that this is a average condo. This happens to be in what's called Midtown, a nice area, not the best area of the city, of course, but it's average to better area. And you'll look at this, a 1+1, okay? And what that means here in Canada, from what I've seen anyway, the +1 is not an actual room. It's just a little cutaway, usually, and you could probably see it in this side over here, just a little cutaway on the side. Doesn't even have a door. It's not actually a real room. And you're seeing $569,800 for this. You have a shoebox, and you're going to pay nearly $600,000 when you factor in closing costs and everything else. It's not particularly renovated. It's just a nice place, okay? But you're paying nearly $600,000 Canadian. That is an excessive number for what you get. What has happened to real estate prices in the recent past? Well, I'd like to bring you this information. Ontario, the world's most indebted sub-sovereign borrower, is plowing ahead with Canada's most ambitious infrastructure plan, risking the center of the S&P's and underperformance of its $307 billion of bonds. Talking about, it is the most populous province, it has a lot of debt, but it's going to pay that all off. This information was actually from 2015. But I just wanted to show you the fact that as a province, Ontario is heavily in debt. Ontario as a province exports 87% of their goods to the US, and lo and behold, the Crown, the monarchy, owns approximately 87% of the land in Ontario. Just thought I'd throw that little tidbit in there. This here is from Maclean's. Here is just a sample of recent files that we have crossed our desks: a staff accountant with multiple lines of credit, several maxed out credit cards, a big mortgage, a significant home equity line of credit, and 2 leased luxury cars, a TTC driver, that's the metro or the subway system or the bus, with 2 mortgages, $100,000 in unsecured lines of credit, a teacher with 8 payday loans, a senior financial analyst, and a chartered bank with 7 credit cards, all carrying high balance. I could go on and on. The amount of debt that is being allowed is absolutely ridiculous. In fact, the household debt to income ratio now stands at 169.4. That's up 23% from a decade ago. You cannot sustain this level of debt. It doesn't matter what housing prices are at. It doesn't matter. You're looking at 169% debt to income ratio. That is absurd, that is unsustainable, and that will correct. Either people are going to receive major bonuses all across the line. You're going to see the companies be generous and double your salary, or things have to correct. That's a fact. Do you think that your employers will give you double your salary tomorrow? I don't think so. I just don't believe it. So we can expect that there will have to be a correction. That is just the way it is. Historically, statistically, mathematically, there is no other way around it. People can't afford their lives. When you pay $600,000 for a 1-bedroom condo, you don't have the ability to buy your normal things that people do. That your food is all of a sudden makes up too much of your expenses. You're seeing that people are struggling, essentially, to pay their energy bills, to pay their food bills. At the end of the month, they have no savings, so they go further and further and further into debt. This article here basically talks about the seriousness of the situation, how it has become more and more pervasive. Debt, holding onto debt, is okay, and that's not going to end well. And that's what has persisted throughout the Canadian economy, that we have been living off of our real estate prices rising. When you take a look at areas which the real estate has gone down, all of a sudden you get a much, much better picture. Look at the areas around the tar sands in Canada, and you will see that very clearly. Real estate came down, the economy is down, everything is suffering there. And that's because of the real estate. It's very clear. Shows you that specifically. This is a real estate agent that I found, their page. It's just the way that it is presented to the Canadian people, and you will see this here. My prediction is that over any 5-year term, from here until forever, prices in Toronto will never fall, ever. Will never fall, ever. And that's what we are presented with in the mainstream media. You'll hear that from those in the industry. You'll see that in the financial services sector. You will get that from the people down the street, and your barber, and your neighbor, and everyone else. Prices will never fall. I present you with a little bit of a contrarian discussion, that because of the debt that we are in, people will not be excused of their debt, and it will come back to haunt them. Should prices come down or interest rates go up, causing prices to come down, we will have a major catastrophe. Now, it might take 2 years, it might take 5 years. I don't know when it's going to happen, but when it does, the longer it takes to happen, the worse it's going to be. That's what people don't realize. Oh, it's going up and up and up. This is wonderful. This is great. No. That just means more people are taking on more debt. There will be more bankruptcies. There will be more issues that they have to deal with when the time comes. Don't see this as a good opportunity to take on more debt. It is a very big mistake. People are screwing over their futures, and I am trying to warn about that and being ridiculed all along the way. If you found this video informative, please give me a thumbs up. Last but not least, if you found the video informative, I know you will find my books, The Money GPS, and my new release, Global Economic Collapse, even more informative. You can flip through these books at Amazon. The links are in the description below. The first book is about the 4 asset classes and how to profit from it. I talk about real estate in there. I talk about Canada in there, relationship with gold to real estate, for example. And in my new book, I get into familiar topics, but I also get into earning income and tax incentives that you can use and reducing your monthly expenses and so much more. So you can check those out at Amazon. Links are in the description below. Take care.